Hi everyone, welcome to this live coverage. As usual, we are here with you to help you go through this event. We are with Yohay Elam from Forex Crunch, and me from FXStreet. Hi Yohay, how are you?
Hi Valeria, I'm doing great. We already had some action before the event, and hopefully the Fed will provide even more action.
Yeah, indeed. We're expecting the Fed to provide a 25 basis point hike, right? Pretty much priced in ever since, I don't know, 2 months ago. But of course, the market is expecting dovish stance afterwards, with the Fed making a pause in their tightening path amid poor data. And well, as we have seen earlier today, inflation, soft inflation, right, confirms that vision of the market. So pretty much we are going to see further dollar weakness over the upcoming hours, although unless we have another nasty surprise from the Fed, I'm not sure if the dollar can give up further ground, because pretty much that's what the market is expecting, right? Only surprises can trigger big moves today. What's your take, Yohay?
Yeah, the Fed doesn't like to surprise us, and markets don't like surprises. So despite weak data, wages are stuck at 2.5%. We had a fall in inflation figures. Growth is very poor in Q1. We're expecting to see a rate hike, and then it all depends on the dot plot for the immediate reaction, and then the statement, and then the press conference. For me, the big question is, are they going to slow down the path of interest rates, of rate hikes? And they will also begin talking to us about QT, quantitative tightening. That means reducing their $4.5 trillion balance sheet. But I think the markets are more interested in when is the next rate hike.
Indeed, the market is paying a bit more attention to rate hikes, although, well, ever since March meeting, the Fed has been hinting us that they are planning to start reducing that balance sheet, and it has become part of the usual moaning between Fed officials, right? But, well, we have to wait and see. Anyway, I don't know if you want to share with us a preview of what we could expect today.
Yeah, let me get that together. I prepared a short preview for the morning show, and we have a few minutes. So basically, we're expecting a dovish hike. Most important thing, did the Fed change its mind at the last moment and decide not to raise interest rates? Probably so. If there's no rate hike, of course, the dollar will crash. Secondly, the dot plot, was there a change? Was there any kind of a downgrade? Probably not a downgrade for 2017, but maybe for 2018. And if of course, an upgrade will push the dollar higher, an upgrade dollar lower. And the third, what is the tone of the statement? Are they more optimistic, or about that they will say that weak growth is only transitory, or are they more optimistic, more pessimistic, worried about inflation, and they should be, or worried about wages, and in this case, the dollar could fall. Okay, so basically that's what we're expecting, and perhaps we'll get a hint about the balance sheet, 4.5 trillion, but it'll probably be as slowly as possible. The same thing with QE. They don't want any kind of taper tantrum, so the message will probably only be at the press conference, and it'll be very smooth, very gradual. So we have a lot of things to digest, and the reaction will also take some time. At 6 GMT, we have the decisions, the dot plot, the statement, the new forecast, and the press conference. But another reaction will be seen at the Tokyo Open at midnight GMT, and another one at 7 at the European Open. So usually there's a lot of tension before the Fed decision, and then a lot of ongoing reactions. So it's not only one reaction at the publication.
Yeah, indeed. We are going to have, of course, a reaction of the market, but, well, as Wall Street comes to an end, volumes usually fall, and therefore market action will resume with the key opening, as you have just said. Anyway, the euro dollar managed to reach a fresh yearly high, right? A fresh high for this 2017, although it's still a couple of pips below the immediate high post as a result of Trump's victory back in November, when we traded as high as 12.99 for me in 113. Today we have been at 12.95, so we are trading quite close to the level. So I do believe that if somehow the Fed disappoint us, giving us a dovish message than the one the market has already priced in, there's a good chance that the pair will break above this 13 area and run higher. 13.45 is the immediate support resistance for me. But once the pair broke above 13, I will look back toward this region, which is 14.50, 14.60, right? Because if you take a look at the weekly chart, the price has been unable to settle above this weekly basis since January 2015, right? So this is a line in the sand for the pair for me, right? We are not that far away, 180 pips right now. We can get even closer after the Fed, right? And given that the strength of the resistance, the long time it has been on hold for prices, the break above it could be quite significant for common currency. At least for the next couple of weeks, right? Of course, there's a lot going on in Europe and the US, so maybe the movement can be sustainable, but a break above 13 and a daily close above this level will expose that 1460 region for me, right? And on the other hand, I won't be much concerned about the bullish trend in the euro we have seen lately, unless the pair actually breaks below 1075, which is the low of May 18, right? When Theresa May announced I'm sorry, no, she called out in April, not in May.
April 18th,
anyway,
yeah.
Yeah, sorry, I mistaken the month. Anyway, unless we break below that low, which is the lowest for the past 4 weeks, 1075, I don't see much of downward potential in the pair, right? We have been stuck in a wide, well-defined range between 11 and 13 for 4 weeks already. I was thinking that if there is a chance the pair can break that range, it's the Fed, and or how the price has reacted today, since the market is really wishing to break towards the upside, right?
Yeah, we had quite a recovery. I think one of the things that pushes pound higher is that we're going to have probably a government, and despite some opposition from within her party, the Conservatives will let Theresa May continue. And there are also hopes for a softer Brexit. So yeah, levels I see here are, well, 129.80, then 130.50, and if we have a real break, then 131.30. And to the downside, well, actually, it's at 126.40, more or less. Sorry, 126.10, 26.40. That's the range.
Yeah. And what about Lord Yen? Back towards the low. I was thinking that the pair has broke above this Fibonacci retracement, the 61.8% of the April-May bullish run. It has completed a pullback to it, failure to break, now at fresh lows. Somehow, I'm hoping the pair can reach this low, 108.10. But honestly, if we break below that level, I'm not sure how long or how far the yen can go against the greenback. Anyway, as it has been moving lately, any kind of movement in dollar-Japanese yen will be a reflection of what's going on in American Treasury yields, right? If yields are down, the pair will be down. If yields are up, the pair will be up.
Yeah, when we had that poor data earlier today from inflation figures, we've seen yields falling and dollar yen falling with it. For me, the line in the sand is, of course, the cycle low here in April of 108.10. And we're not that far from that. 100 pips is not rare to be on dollar yen. A few years ago, dollar yen was moving very slow. Nowadays, it's looking good. I'm looking at 111.60, which used to be a triple bottom, and 112.20. In any case, I think this pair will be the best reflection of what the Fed decides.
I do agree with you with that 11.60 being the first resistance area. Although, to be honest, I would like to see a pair, I don't know, 14.40 or so above that area to call for an upward reversal. there's no chance, so there's no technical sign that the large Japanese yen can change this bearish bias. And I guess that adding to this dovish Fed we are having today, the political scandals and the surrounding Trump and the absence of the so promised structure investment and tax reform so far today are also another factor weighing on the dollar longer term, right?
Yeah. So last week, James Comey did not provide anything new. He basically told us what we already have been told by the press, what we already knew. But the scandal, the fact that it's going on, pushes back infrastructure, pushes back tax cuts. So I think markets are a bit disillusioned, from Trump, and this could eventually reach the real economy.
Yeah, he couldn't even take down the Obamacare bill, the Obamacare plan with his own bill, with his own party. So pretty tough situation for our friend Donald, right?
Yeah, 7 years. During 7 years, the one thing that united the Republicans was to repeal Obamacare, and they failed at the first attempt. The second attempt is not going so well.
Not in there. Another one going nicely today is the Aussie, right?
Oh yeah, finally woke up.
Yeah, I finally woke up. I was thinking that Chinese data released overnight was not that good because we have steady readings in industrial production and in retail sales. Right now, no big surprise, despite beating a bit expectation. It was not a huge advance for the Chinese economy. But headlines showing that the euro area, the European Central Bank, is changing its dollar holdings into yuan holdings. Maybe one of the reasons that helped the Aussie rally today. Anyway, the 77 region, it has been really, really tough. And selling interest has been surging on approaches to it for very, very long. So beware, guys, and rally towards that level, particularly in the short term, because the pair has already advanced at around 100 pips today. So once if it gets 100 more, there's a good chance that the market will rush into profit taking. Okay, beware of that.
Yeah, for me, an important line was 76.10. We're just a bit above this line. It was resistance in April and support back in February. And the next line, as you said, 77 region. But a lot depends. If you're trading the Australian dollar, we have the Australian jobs reports tonight at 1:30 GMT. So it's not all about the Fed for the Aussie.
For the Aussie, yeah. In fact, there have been good readings coming from the Australian employment report, right, for the past 2 months, with big headlines showing a lot of job creation. But the fact is that it's part-time jobs, and in fact, last month, full-time jobs fell by 11,000 or so, a bit more, I believe. So beware of that tricky headline you may get today, and take a second look before trading to whatever full-time jobs creation reading is.
Yeah. Okay, we have 30 seconds to go.
Okay, guys, remember, at a bit of delay, you will see the reaction in price first, and then our calls on what happened. But indeed, you will see whatever happens in charts. Imagine if the Fed does not hike. Oh, whoa. Party on.
So we have a decision. Dollar is falling. Dollar is falling quickly.
Yeah, but
Fed hikes. Largely expected. So we do have a rate hike. The Fed did not change its mind. They did decide to raise rates as expected. So we have and let's see the statement. Let's see if we have there. After the initial fall, dollar yen was at 108.80, and now it recovered. Let's read the statements and the top buttons.
Yeah.
What's going on?
Let's see.
So let's see what they'd say about inflation, for example. No, they say that survey-based measures of long-term inflation expectations are little changed on balance. So that's a repeat of previous statements.
Yeah.
Now the US dollar is on the rise again. See the dot plot?
About the normalization and balance sheet. They say that they expect to begin implementing the balance sheet normalization program this year.
Okay, so in the meantime, dollar yen is rising. I see a line there at 109.50, but it's very volatile. Markets are still digesting the news. They maintain the forecast for one more rate hike in 2017, so no change in the dot plot, at least for 2017. So that's important. That's also one of the immediate things that we're watching.
There was a dissenter.
I believe so. I would expect Kashkari to dissent again. Let's. Yes, Neil Kashkari was the only one dissenting. He preferred at this meeting to maintain the existing target range for the federal funds rate. So that was expected. He also voted against the decision to raise rates back in March. So that's not a big surprise. Of course, it's a bit negative for the US dollar, but not a huge surprise.
Yeah. Still waiting for 3 rate hikes this year, right? According to the dot plot.
Yeah. Let's look at other currency pairs. Euro dollar.
Little action. Only the yen seems to be easing more than the rest. The Fed has provided exactly what the market was expecting, and therefore market reactions limited so far. We have to hear from Yellen.
What's that noise? Whoa. Sorry. I was here. Nothing happened.
Oh, okay.
The Fed says it's monitoring inflation developments closely, so that may be a sign of worry, but
yeah, maybe the statement so far, for what I read, sounds a bit more hawkish, right, than what the market was actually expecting. But it's clear that the market was not waiting for this and not willing to buy the greenback. So that's why we are having a sharp recovery so far. I guess we are going to have to wait for Yellen's word and see whether somewhere between within the press conference, he offers some clearer clues.
Yeah. Let's see if we have the dot plot.
I'm following a bit yields, and I see that after plunging earlier today, they are aiming to regain some ground, but still at low, so that's preventing the dollar yen from advancing much.
So now I'm presenting here on the screen the dot plot. Basically for 2017, they're converging around one more rate hike.
Yeah.
In the longer run, it's close to 3%. So no change in the dot plot. That is as expected, no upgrade, no downgrade. So the dollar all in all is reacting positively. I think one of the reasons for that is that earlier today we had the weak inflation data that sent the dollar lowered expectations for today, but the Fed probably is not so data dependent, like it tells us, did exactly as was expected before the data came out, and the US dollar is responding positively. So far the range is around 50 pips, and dollar yen 55 pips.
Yeah.
Okay. For viewers, listeners, you're welcome to ask questions in the chat.
Yeah. Seems the market burned all its bullets earlier today with inflation and retail sales, which were also under expectations.
Yeah, let's see if we're. Yeah, also your dollar is sliding. Bigger effect, as in many cases with US events, is seen on dollar yen, but we had a small jump to the upside, 112.89, and fell to the lows of 112.52. And now we're just a bit lower at 112.62.63. I think 113 is critical resistance there.
Yeah, indeed. The forecasts beyond rate hikes. Do we have forecasts on inflation?
I'm looking for that. The Fed median 2017 core PCE inflation is 1.7 against 1.9 last time. So that's a downgrade. And they see longer term employment at 4.6 instead of 4.7. That's also a downgrade, but in this case, a positive downgrade. They want lower employment. So they did lower their inflation forecast, basically acknowledging reality, that is that prices are rising quite slowly.
Okay, we have a couple of questions. The first one is, hello, is this rate rise more for short term or mid term? I imagine that it's talking about the market's reaction to the raise. And to be honest, the reaction seems to be purely short term. We are not going to see much more of a reaction unless we have some surprises coming from the statement. That's my view. As we said at the beginning of the coverage, the rate hike was already priced in, so it was actually not a big surprise. Any kind of surprise can come later with the press conference, although we are seeing a bit of a dollar strength right now, as I believe that the sorry, the general statement and the dot plot were a bit more optimistic and the statement, I mean, was a bit more optimistic than what we were all expecting. What's your take, Yohay?
All in all, the Fed did what we expected it to do, well, what it guided us that it's going to do, and it contrasts the surprisingly weak data that we've seen earlier. It's the main reason for the slightly positive reaction in dollar yen. They also laid out a plan for reinvestments. They will slowly halt reinvestments with adjustments until they reach 30 billion per month in treasuries and 20 billion in MBS. Very, very gradual, not rocking the boat. For me, what stands out is that they did acknowledge the drop in inflation, so they expect it to stand at 1.7 instead of 1.9 core PC. And I think that, and they left the dot plot unchanged. But if inflation remains lower than their lower expectations, maybe they'll change their minds. So I think we're expecting now a rate hike in December, and I'm not sure that will happen if slowdown continues.
Okay, yeah, since the Fed's not concerned about lower inflation so far, at least at this point. There are a couple of more questions. To put it simply, was the Fed dovish than expected today? In fact, no, it was the opposite. It was a bit more hawkish than expected, in my view. Right, Yohay?
Yeah, I agree.
A bit more optimistic, just a bit, but a bit more optimistic than maybe what the market was waiting for. Not hugely optimistic. Has no base material to work for a hawkish stance, but unless it was not that dovish. Okay, we have another question. What do you think about euro dollar? You want to take that, Yohay?
Yeah, euro dollar since the beginning of the year is enjoying an uptrend. It bottomed out at the very beginning of the year. The trend remains to the upside. The fundamental reasons are politics. They look better in Europe now, especially after the French elections. You can see that weakened gap. In comparison to the US, monetary policy is also very gradually moving to a more hawkish stance. And yeah, on the technical side, you can see the higher lows and then higher highs. Currently, we're in some kind of range. 113 is critical to the upside. Above 113, I see 113.60, 114.20. As you can see on the chart, these are the next levels that were, worked as resistance to the pair. Let's add this. And to the downside, I look at 111.60 and 111 as support. Currently, we're in range, but I think the trend hasn't changed and remains to the upside. What do you think?
I do agree with you. As I said earlier, I would like to see the pair breaking below that low around 1075, 1080 that we had mid-May before calling for a bearish breakout in the euro. If you take a look at the dailies, weeklies, have been consolidating for 4 weeks already and always rather pressuring the upside of the range in the upper half of it rather than the lower end. So the risk for me is also towards the upside in here. There's another question. Someone's asking, what about gold? The fact is that usually gold tends to react like the euro, right? With this kind of events, they trade in parallel. The fact that the negative news hit the greenback helped the commodity, to recover some ground today. But the fact that the Fed has actually provided a rate hike, and it's promising another one for this year, and not looking very concerned about the drop in inflation we have seen today, is waiting on the commodity because, rate hikes will always tend in the US, it will always tend to send the commodity lower, right? Anyway, as in the case of the euro, there's still not a clear sign that the bullish momentum is over and there's an interim top going on in here. But my take today is that we will probably see some further declines, particularly if we lost this area around 1269, 1270. If you take a look at the forward charts, we have plenty of highs and intraday highs and lows in that region. So below it, there's a good chance that we'd see a deeper correction down to a 64, 63 or so. Those are the levels. And below that, I do see scope for a decline down to 45, 45.20, which is also a major relevant support. But given the dollar strength, it's on up because of political scandals. I'm not sure. I'm not seeing the gold falling farther lower. Of course, Fed is waiting on it. And if we have a confident Yellen in the speech, we will probably see it falling farther, okay? Okay, we have another question. Do you see the agreement again to 110? Do you see it, Yohay?
To 110, that's not so far away, so why not? Currently 109.30, and we were above 110 earlier today, so if the current trend of recovery continues, 110 is certainly possible. What do you think?
I'm taking a look at the 10-year yield that stands at 12.12, barely bouncing and still over nearly 4 points down daily basis. So not sure everybody again could move those mostly 70 pips higher. You know, I know it's just 70 pips what we're talking about in here, but unless yields bounce, there are no chances that the Japanese yen will run higher. In fact, if yields keep falling, despite whatever else happens in the market, the dollar yen will probably fall alongside. So I would keep an eye on yields with the Yellen speech. To be honest, that's my take in there.
Yeah, we have Yellen beginning her press conference in about 12 minutes. It'll be broadcast live here.
Okay, we are going to make some comments, guys, in the chat room, the bed. So if you have questions, you're welcome to share with us in there as the press conference goes by. And if there are some big headlines, we will also post them there. Okay, we have a question on pound Swissy. Do you follow the pound Swissy, Yohay?
No, sorry. I don't like the Swiss franc in general because the S&B intervenes there. It's not such a good currency to trade. We're just look at the Euro Swiss, which is on the up, because the euro is on the up, but I don't know about pound Swiss.
Okay, Vic, we are really sorry, but the pound Swiss is not a pair that I follow also. Sorry, because as Yohay said, every Swiss franc cross, okay, has much more to do with the S&B interventions, daily ones, than whatever was going on in the market, and that happened ever since before they lift the peg. It's a long story, and yes, the peg and the lifting of that peg a couple of years ago scared us all and left us all without watching. But let me tell you something. The S&B is really fighting to weaken the Swissy, right? And the pound today is rising, and on hopes that the Brexit will be softer than initially expected, right? So maybe there's some upward potential in that particular pair because of, in the short term, I mean, because of pound strength and the Swissy, right? But don't bet much on pound strength.
Yeah, it's a soap opera now in the UK with politics. It's quite a roller coaster. One thing that could push the pound higher is if we have a change in the stance of the UK government about Brexit, if they move to a soft Brexit, like Cameron is suggesting, John Major is suggesting, the Labour Party offers. If May changes her mind on that, it will be, of course, positive for the pound. But if current situation of hard Brexit continues, we have a weakening economy, and we can see the pound slide. Earlier this week was a fear that we would have another round of elections. That's gone, at least for the very, very near future, or near future. But Brexit is still a big cloud hanging over the pound.
Okay, there's another question about the dollar CAD right now. Well, there was a huge surprise as the Bank of Canada officer comment, Wilkins, right? She commented about the possibility of beginning tapering on reducing using in Canada, and 24 hours later, that happened on Monday. And on Tuesday, we have Governor Paulos saying that, well, yeah, indeed, easing has that did its job, so it works. So here we are with the dollar CAD plunging because of CAD strength and speculation. They will start tapering. I do believe that, of course, today we are seeing a retracement in that bearish run or bullish run of Canadian dollar because of price of oil plummeting, right? But overall, the trend in here is quite bearish. I don't know, Yohay, if you want to give us a technical outlook for today for dollar CAD.
Dollar CAD, yeah, as you said, well, it was Wilkins on Monday and then Pelosi on Tuesday. Currently, I'm looking at 131.80. It was breached earlier. This was a line of resistance in the past, back in May last year, and was only a temporary breach below a find 130.80, which was support back in April. But of course, everybody's looking at 130. Technical support, I find it only at 129.70, which was the low here in at the end of January. If we break above the below this line, then I see support only at 128.30 and 128, which were lines of support late last year. On the top side, I find 133.80, which was support the low just before this big fall last week. It was in May, and then high resistance at 135.40. All in all, the Canadian economy is improving, and the Bank of Canada acknowledges that. Of course, always keep an eye open for the price of oil, which is actually weaker also today. But the Canadian dollar, fundamentals of the Canadian economy this week win over oil prices.
Yeah, beware of particularly Wednesday when we have the AER report in the US, report in stockpiles. Today we have a 1.8 million, 1.6 million, right, barrel drop in the US last week. But there was a very large build in gasoline stocks, and that's what waiting on crude oil prices today. And that's why the Canadian dollar can go farther lower or farther higher, right? Meaning the dollar can lower, the Canadian dollar itself higher against its rivals. But given that oil prices plummet to fresh 5-week lows, and the dollar CAD is holding near its daily low, it seems that maybe fundamentals will start weighing in more than oil prices in the CAD, right? Beware of that. However, on Wednesday, when we have the US stocks by reports, maybe it's a good idea to stay away from the pair, at least for a while, until the market reaches the news and we see this initial reaction. If you compare the candles, you will notice that they tend to go along for the past weeks until Monday, when we have Wilkins and, of course, Paulos on Tuesday.
Yeah.
Okay, 5 minutes to go for Yellen. Remember, guys, we are going to mute our micros and share with you our comments. You can join us in this chat room. I'm sure I've shared it. You're welcome to come with us in there. We're going to share your comments in there.
Yeah. So for those of you joining just now, the Fed decided to raise interest rates as widely expected. They still forecast one more rate hike in 2017. They did not change the dot plot. This comes on the background of weak inflation data today. They didn't acknowledge inflation data by changing some of the forecasts and saying that they will monitor inflation developments closely. But these words, these change of forecasts, don't mean a change in the decision today or the decision or the probable rate hike later this year, probably in December. Given this background, the US dollar is stronger across the board. The moves are not huge, but the dollar is stronger, slightly stronger. few more minutes. Yeah, at first, usually, chair of the Fed, Janet Yellen, reads the statement, or reads a prepared statement, and after around 10 minutes, we have a Q&A session, which lasts around an hour. Most of the news comes at the beginning. I expect many of the questions to be about the Fed's intention to reduce the size of the balance sheet, what's also called as quantitative tightening, the opposite of quantitative easing. And hopefully, my question is, well, if I would be there, would be to ask, why did you raise rates and why didn't you change the path of rates despite the falling inflation and despite no wage pressures? But I assume somebody will ask that question.
Okay, 2 minutes to go.
Yep. So,
yeah, I'm taking a look at the CC and seems to be a bit more active than the euro, the euro dollar, rising slightly, almost trimming the losses triggered by the US poor data earlier today.
yeah.
Probably because the CC is taking its chance.
Yeah, Yellen is set to speak in a minute or two.
Remember, guys, we are going to make comments in the chat room if it's worth it. Hoping so. We're going to go mute as soon as Yellen starts speaking for a while until we get the most relevant statement.
Okay. Yeah, so she's about to begin talking any moment now.
Okay. Sorry, guys. Seems that the Fed website is transmitting horrible. Let's try again.
A solid rate of growth that, although a little slower than last year, remains well above estimates of the pace necessary to absorb new entrants to the labor force. The unemployment rate has fallen about a half percentage point since the beginning of the year and was 4.3% in May, a low level by historical standards and modestly below the median of FOMC participants' estimates of its longer run normal level. Broader measures of labor market utilization have also improved this year. Participation in the labor force has been little changed on net for about 3 years. Given the underlying downward trend in participation, stemming largely from the aging of the US population, a relatively steady participation rate is a further sign of improving conditions in the labor market. Looking ahead, we expect that the job market will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures was 1.7% in April, up from less than 1% last summer, but down somewhat over the past few months. Core inflation, which excludes the volatile food and energy categories and tends to be a better indicator of future inflation, has also edged lower. The recent lower readings on inflation have been driven significantly by what appear to be one-off reductions in certain categories of prices, such as wireless telephone services and prescription drugs. These price declines will, as a matter of arithmetic, restrain the 12-month inflation figures until the extraordinarily low March reading drops out of the calculation. However, with employment near its maximum sustainable level and the labor market continuing to strengthen, the committee still expects inflation to move up and stabilize around 2% over the next couple of years, in line with our longer run objective. Nonetheless, in light of the softer recent inflation readings, the committee is monitoring inflation developments closely. Let me now turn to the economic projections that committee participants submitted for this meeting. As always, participants conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the many factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product, or real GDP, is 2.2% this year and edges down to 1.9% by 2019, slightly above its estimated longer-run rate. The median projection for the unemployment rate stands at 4.3% in the fourth quarter of this year and ticks down to 4.2% in 2018 and 2019, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.6% this year and rises to 2% in 2018 and 2019. Compared with the projections made in March, real GDP growth is little changed. The unemployment rate follows a moderately lower path, and inflation, although marked down this year for reasons I mentioned earlier, is unchanged over the following 2 years. In addition, the median estimate of the longer-run normal unemployment rate moved down a tenth to 4.6%. Returning to monetary policy, for the past year and a half, the FOMC has been gradually increasing its target range for the federal funds rate as the economy has continued to make progress toward our goals of maximum employment and price stability. Our decision today continues this process. We continue to expect that the ongoing strength of the economy will warrant gradual increases in the federal funds rate to sustain a healthy labor market and stabilize inflation around our 2% longer-run objective. That's based on our view that the federal funds rate remains somewhat below its neutral level. That is, the level of the federal funds rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel. Because the neutral rate is currently quite low by historical standards, the federal funds rate would not have to rise all that much further to get to a neutral policy stance. But because we also expect the neutral level of the federal funds rate to rise somewhat over time, additional gradual rate hikes are likely to be appropriate over the next few years to sustain the economic expansion. Even so, the committee continues to anticipate that the longer-run neutral level of the federal funds rate is likely to remain below levels that prevailed in previous decades. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate is 1.4% at the end of this year, 2.1% at the end of next year, and 2.9% at the end of 2019, about in line with its estimated longer-run value. Compared with the projections made in March, the median path for the federal funds rate is essentially unchanged. As always, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate and respond to changes to their economic outlooks and views of the risks to their outlooks. As I've noted previously, policy is not on a preset course. Let me now turn to our balance sheet. As I noted in our policy statement, we are continuing to maintain the size of our balance sheet by reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. Provided that the economy evolves broadly as the committee anticipates, we currently expect to begin implementing a balance sheet normalization program this year. Consistent with the principles and plans we released in 2014, this program would gradually decrease our reinvestments and initiate a gradual and largely predictable decline in our securities holdings. The addendum to our policy normalization principles and plans that we released today provides further information. For both Treasury and agency securities, we will reinvest proceeds from our holdings only to the extent that they exceed gradually rising caps on the reductions in our security holdings. Initially, these caps will be set at relatively low levels, $6 billion per month for treasuries and $4 billion per month for agencies. So any proceeds exceeding those amounts would be reinvested. These caps will gradually rise over the course of a year to maximums of $30 billion per month for treasuries and $20 billion per month for agency securities, and will remain in place through the normalization process. By limiting the volume of securities that private investors will have to absorb as we reduce our holdings, the caps should guard against outsized moves in interest rates and other potential market strains. As I previously noted, when our securities holdings begin to gradually decline, so too will the supply of reserve balances in the banking system. At some point, probably a few years down the road, the committee will bring the decline in our balance sheet to an end as the quantity of reserves is normalized. I can't tell you what the longer run normal level of reserve balances will be, because that will depend on the committee's eventual decisions about how to implement monetary policy most efficiently and effectively in the longer run, as well as a number of as yet unknown elements, including the banking system's future demand for reserves and various factors that may affect the daily supply of reserves. What I can tell you is that we anticipate reducing reserve balances and our overall balance sheet to levels appreciably below those seen in recent years, but larger than before the financial crisis. As readers of our minutes know, the committee has on previous occasions discussed potential long-run frameworks for implementing monetary policy. Decisions about the appropriate long-run framework do not need to be made for quite some time, and our future deliberations will benefit from the experience we will gain during the normalization process. At this point, I'll just point out that our current system is working well and has some important advantages. In particular, it's simple and efficient to operate, does not require active management of the supply of reserves, and most importantly, provides good control of the federal funds rate and effective transmission of changes in the federal funds rate to broader money market rates. And because our current system is likely compatible with a much smaller quantity of reserves, our plan for gradually reducing our balance sheet does not constrain the committee's future options for how to implement monetary policy. Finally, as noted in today's addendum, the committee affirmed that changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. In other words, the balance sheet is not intended to be an active tool for monetary policy in normal times. However, the committee would be prepared to resume reinvestments if a material deterioration in the economic outlook were to warrant a sizable reduction in the federal funds rate. More generally, the committee would be prepared to use its full range of tools, including altering the size and composition of its balance sheet, if future economic conditions were to warrant a more accommodative monetary policy than can be achieved solely by reducing the federal funds rate. Thank you. I'll now be happy to take your questions.
Nick Timmer, the Wall Street Journal. Chair Yellen, the principles you released today say the balance sheet wind down should commence once interest rate normalization is well underway. With this latest rate increase, do you believe normalization is now well underway?
So that is something that we've said for some time, and I've previously, when I've been asked what well underway means, said that I don't want to define that in purely quantitative terms, but rather in qualitative terms. So there's no specific level of the federal funds rate that means we're well underway. But it's also a question of not only the current level, but our confidence in the outlook and our projections for the future path of the federal funds rate. So we have increased our federal funds rate target now several times. Our outlook is that we anticipate further increases this year and next year for the federal funds rate. And our statement indicates that if the economy continues to evolve in the manner that we expect, that we would feel the conditions will be in place to begin this process this year.
Madam Chair, I'm wondering if you've talked to the president or members of his staff about the possibility of staying on as chair for a second term. I'm also wondering if you would consider doing that. That's something you've thought about doing. And finally, there are 3 vacancies on the Fed. Do you have any comment at all for the president about his failure to nominate anybody for those 3 positions? Thank you.
So what I've said about my own situation is that I fully intend to serve out my term as chair, which ends in early February. I have not had conversations with the president about future plans, and I do very much hope, I know that they have been working hard to identify appropriate nominees for the open slots, and I do very much hope that there will be nominations in the not too distant future and that the Senate will take those up expeditiously. I look forward to having a full board.
Your desire to stay on?
I really don't have anything for you at this point.
Thanks very much. Sam Fleming from the Financial Times. We've now had a very long streak of, or fairly long streak of weak inflation numbers, at least measured by the CPI this morning as well. Marketplace-based inflation expectations are declining. What kind of vigilance are you now saying is needed in terms of weak inflation? How does that interact with your policy outlook? And would further disappointments argue for pressing calls on rate hikes or delaying balance sheet runoff? How do you think about those 2 potential responses to weak inflation?
So let me just say, as I emphasized in my statement and always say, monetary policy is not on a preset course. We indicated in our statement today that we're closely monitoring inflation developments and certainly have taken note of the fact that there have been several weak readings, particularly on core inflation. Our statement indicates that we expect inflation to remain low in the near term, but on the other hand, we continue to feel that with a strong labor market and a labor market that's continuing to strengthen, the conditions are in place for inflation to move up. Now, obviously, we need to monitor that very carefully and ensure, especially with roughly 5 years of inflation running under our 2% objective, that is a goal to which the committee is strongly committed. And we need to make sure that we have in place the policies that are necessary to achieve 2% inflation, and I pledge that we will do that. But let me say, with respect to recent readings, it's important not to overreact to a few readings, and data on inflation can be noisy. As I pointed out, there have been some idiosyncratic factors, I think, that have held down inflation in recent months, particularly a huge decline in cell telephone service plan prices, some declines in prescription drugs, We had an exceptionally low reading on core PCE in March, and that will continue to hold down 12-month changes until that reading drops out. But we are, this morning's reading on the CPI showed weakness in a number of categories, and it's certainly something that we will be closely monitoring in the months ahead. We're focused on making our policy decisions on the medium-term outlook, and we will, be looking carefully at incoming data, and as always, revising our outlook and policy plans as appropriate. So, continue is today's actions show to feel that the economy is doing well, is showing resilience. We have a very strong labor market, an unemployment rate that's declined to levels we have not seen since 2001. And even with some moderation in the pace of job growth, we have a labor market that continues to strengthen, and policy remains accommodative. So it's important that inflation move up to our 2% objective, as our projections show. We continue to expect that and believe the conditions are in place. But we will monitor incoming data, obviously, and be attentive to rethinking our outlook if it seems appropriate.
From Bloomberg News. Hate to belabor the point on inflation, but I was wondering, I hear a lot of the so-called NIRU in your conversation now and in other committee members. It's an unobservable thing. At best, it's an estimate. And the assumptions in there seem to me that the economy today is much like the economy yesterday, when if anything, we've learned that the post-recession economy is vastly different than it was before the recession. So I'm wondering, something you've talked about is to focus more on the change in inflation. Actual inflation, and is it going up or is it going down, and basing policy more on that? What would be the risk of that, and why not adopt that if you have such a long period of underperformance?
Well, we are closely looking at the actual performance of inflation and altering our views on the basis of discrepancies between what we see and our expectations. And while it is very difficult to pin down what is the longer run normal rate of unemployment, and there's a great deal of uncertainty about it, and it's hard to pin down, especially given the fact that the so-called Phillips curve appears to be quite flat. That means that inflation doesn't respond very much or very quickly to movements in unemployment. Nevertheless, that relationship, I believe, remains at work. We've seen that operate historically. Now, in the face of very low unemployment that we've seen, while wage growth has picked up somewhat, it remains low. And inflation is influenced by a number of different factors, but we certainly haven't seen much or any evident upward pressure on inflation. In light of that, the committee has successfully moved down its estimate of the normal longer run rate of unemployment. And in this projection, it's moved down to 4.6%, a tenth lower than it was last time. So while the unemployment rate is below that, it's not that much below it.
The Washington Post. We saw measures of consumer and business confidence rise after inauguration on expectations that the administration would move quickly to introduce policy changes like tax cuts and infrastructure spending. But some of those policy changes have been slower to materialize than initially expected. How do you view the positive and negative risks from policy changes to your outlook, and has your view changed on that at all in the last 6 months?
So I would say that business and household sentiment remains quite strong, although many forecasters have pushed back somewhat the timing of expected policy changes, such as changes to tax policy or fiscal policy more generally. I would say that based on my observation of actual spending behavior and my discussions with our wide range of contacts, that I haven't seen very much evidence that thus far expectations of policy changes have driven substantial changes in either consumer spending or investment spending. So I really wouldn't expect any significant pullback. Many of our business contacts, I think their confidence remains high. They've not really changed their plans yet, and they have a wait and see attitude.
Inya Applebaum, the New York Times. Measures of financial conditions show that since the Fed started raising interest rates 2 years ago, financial conditions actually have loosened. Consumer business borrowing costs in many cases are down. Do you have the sense that the market is not listening to you? How much of a concern is that for you? And at some point, does it convince you that you need to raise rates perhaps more quickly?
The appropriate path of rates is we take many different factors into account. We have certainly noticed the stock market is up considerably over the last year. That usually shows up in financial conditions indexes and is an important reason why some of them show easier financial conditions. There's been a modest decrease recently in the value of the dollar, although it's up substantially since mid-2014. So we take those factors into account in deriving our forecasts and deciding the appropriate stance of policy. We've done that, and but other things also affect the stance of policy. So there really can't be any simple relationship. We're not targeting financial conditions of the federal funds rate, that taking account of those factors and others that don't show up in a financial conditions index. We're trying to generate paths for employment and inflation that meet our mandated objectives.
So on inflation again, I just wonder what's the possibility that something more sort of, nefarious is at work here, right? Which is that the sort of weight of central bank credibility now for a generation really, plus globalization has just pushed the world into a low inflation environment that's going to be very hard to get wages and prices moving again. And then related to that, if neighbor is 4.2, why not 4? Why not 3.8? You banked a quarter, a full percentage point now, so you're probably at less risk of falling behind whatever curve exists. Why rush?
So I don't think central bank credibility, at least the Fed's credibility, has been impaired. We look at a whole variety of indicators of inflation expectations. Professional forecasters, whether it's in the blue chip or the survey of professional forecasters, those expectations have remained quite steady and in close alignment with our 2% inflation target. Tips-based measures of inflation compensation do not provide straight reads on market participants' estimates and expectations about inflation. They embody other elements, risk premia and liquidity premia as well. They had moved down and now have moved, they remain at low levels, but they've moved back up again. It is true that some household surveys of inflation expectations have moved down, but overall, I wouldn't say that we've seen a broad undermining of inflation expectations. But you asked also, I guess, about if structural changes perhaps impacted the inflation process. And that certainly is possible. And estimates of the normal longer run unemployment rate, they are quite uncertain. I agree with your assessment there. We're really not certain what they are. And policy is not based on some firmly held preconceived notion. We're watching very carefully how the actual economy performs. And, you know, I continue to believe, though, that with job growth running well in excess, even with a moderation of the level that's needed to provide for new entrants in the labor market, we do have a strengthening economy with policy accommodative. All that we're doing in raising rates is removing a bit of accommodation, heading toward a neutral pace. And I see that as appropriate. We're not moving so aggressively as to put a brake on continued improvement in the labor market. But I think that that's a prudent move to move in a gradual way to remove accommodation with unemployment now, and not only, I should say, the unemployment rate, but I think any indicator of labor market performance and tightness that you could look at, whether it's household perceptions of the availability of jobs, difficulty that firms report in hiring workers, the rate at which workers are quitting their jobs, the rate of job openings, all of these indicators do signal a tight labor market. Now, with inflation below 2%, I think it's appropriate that the labor market be that tight. But on the other hand, I think we want to avoid the risk. We want to keep the expansion on a sustainable path and avoid the risk that at some point we find ourselves in a situation where we've done nothing and then need to raise the funds rate so rapidly that we risk a recession. So moving to some extent in a timely way to remove accommodation with a strong economy and continued labor market strength, the committee believes is an appropriate management of risks. But we are attentive to the fact that inflation is running below our 2% objective, that we've faced that situation now for a long time, and it's really quite essential that we put in place policies that will succeed in moving inflation back to our 2% objective, and it's a symmetric objective. So that's a risk that we face as well. The committee believes we have conditions in place for inflation to move up, but that's also a risk, and those things point, I think, to a gradual pace of reducing accommodation.
Hi, Nancy Marshall-Genzer from Marketplace. Recently, a group of economists sent the Fed a letter earlier this month disagreeing with your 2% inflation target and saying they would like the economy to run a bit hotter. They don't think the labor market is so tight. You say you're committed to the 2% target, but what do you say to them?
So at the time that we adopted the 2% target, it was back in 2012, we had a very thorough discussion of the factors that should determine what our inflation objective should be. And, I believe that was a well thought out decision. Now, at the moment, we are highly focused on trying to achieve our 2% objective. And we recognize the fact that inflation has been running below, and it's essential for us to move inflation back to that objective. Now, we've learned a lot in the meantime, and assessments of the level of the neutral, likely level currently and going forward of the neutral federal funds rate have changed and are quite a bit lower than they stood in 2012 or earlier years. And that means that the economy has the potential where policy could be constrained by the zero lower bound more frequently than at the time that we adopted our 2% objective. So it's that recognition that causes people to think we might be better off with a higher inflation objective. And that's an important set. This is one of our most critical decisions, and one we're attentive to evidence and outside thinking. It's one that we will be reconsidering at some future time. And it's important for our decisions to be informed by a wide range of views and research, which is ongoing inside and outside the Fed. But a reconsideration of that objective needs to take account not only of benefits of a higher, potential benefits of a higher inflation target, but also the potential costs that could be associated with it. It needs to be a balanced assessment. But I would say that this is one of the most important questions facing monetary policy around the world in the future. And we very much look forward to seeing research by economists that will help inform our future decisions on this.
Thank you, Don Lee with the LA Times. The Fed's projections continue to show the longer run federal funds rate at 3%. Markets are expecting 2%. How big of a concern is that gap in your mind? What are the reasons for the disconnect, and what are the implications and the risk for the real economy?
So let me first say it's not straightforward to determine exactly what expectations are embodied in market prices, because there are term premia that affect these rates, and they may not really be as low as one would infer from a straight read. That said, in part, expectations reflect estimates of what the neutral federal funds rate is and how it's likely to evolve over time. And views have changed about that over time, and there is a good deal of uncertainty about it. So we've recently put out charts that try to show what the range of uncertainty is around our path for the federal funds rate, especially as one goes further out. There's a good deal of uncertainty, and that reflects all the shocks that can affect the evolution of the economy, and also the fact we're quite uncertain ourselves about what the evolution will be of the neutral federal funds rate. So we do try to write that down and provide the public with information about our current expectations. And the median now stands at around 3%. But we have uncertainty about that. Many of my colleagues and I think that the current neutral level is lower than that. And as I said in my opening statement, the Fed funds rate path reflects an expectation that that neutral rate will be moving up some in future years. But that remains uncertain, and I think that's something that market participants are trying to assess, and we will be as well.
And what the Fed's projections are for longer run federal funds rate?
Well, our expectations are a little changed. I mean, the projections we released today are essentially identical to those, and I think the market is aware of the views of participants and is assessing evidence itself to form their own views. And it's important that the market take an independent look, and that we get to understand and see how market participants are interpreting evidence on the evolution of the economy. So it's not an unhealthy thing to have such a gap. And as I just said, our own views are not set in stone, but are likely to evolve as well over time.
Marty Kunzinger, Associated Press. Back in 2013, when the Fed first raised the possibility of trimming its bond purchases, it created a bit of turbulence in financial markets. The taper tantrum caused you to reassess your communication of that process. This trimming of the bond holdings, the financial markets seem to be taking that in a better way. If down the road, though, you see that there is more of an adverse reaction, are you planning to make any changes, perhaps change the caps, the 30 billion and the $20 billion caps? How do you assess how you'll handle that going forward?
So we have indicated for quite some time, I guess since at least since our 2014 normalization principles, that we wanted to reduce our balance sheet in a gradual and predictable way. And we have tried systematically to communicate more about how we would do that as our plans have evolved. And today's announcement is another step in providing further details about how we plan to proceed, so that when this plan does go into effect, no one is taken by surprise and market participants understand how this will work. I think that the plan is one that is consciously intended to avoid creating market strains and to allow the market to adjust to a very gradual and predictable plan. My hope and expectation is that when we decide to go forward with this plan, that there will be very little reaction to it, that it's clear how we intend to proceed, and that this is something that will just run quietly in the background over a number of years, leading to a reduction in the size of our balance sheet and in the outstanding stock of reserves. And that it's something that the committee will not be reconsidering from time to time. We think this is a workable plan, and it will, as one of my colleagues, President Harker, described it, it'll be like watching paint dry. That this will just be something that runs quietly in the background. So that's my expectation and our intention. Look, of course, if it turns out that there is a surprise and a substantial reaction, that is something we would have to take into account in deciding on the appropriate stance of policy.
Michael McKee from Bloomberg Television and Radio. A couple of comments from administration officials I wanted to get your reaction to. The Treasury Secretary and others have suggested that Dodd-Frank regulation, the way it's been applied, have restricted credit growth in the economy. Banks are not making loans that they otherwise would, and that has slowed growth. Do you agree with that? And if you get a new vice chair of supervision who wanted to ease up on regulation, would you go along with that? Also, I wanted to ask you, it's been reported the president has congratulated you on being a low interest person. Would you agree with that characterization of your philosophy?
Well, with respect to the impact of credit conditions and bank regulation on slow growth, I've previously in testifying indicated that I don't think that our regulations have played an important role, at least broadly speaking, in impeding credit growth and the growth of the economy. And I pointed in the past to a number of statistics suggesting that credit growth continues to be healthy, including among smaller community banks that are most concerned with regulatory burden. I think when banks are undercapitalized and weak, that impedes credit growth. And when banks are strong, they're in a much better position to lend. So That's been a view that I've stated previously. Now, in terms of regulation, the Treasury recently issued on Monday a detailed report, and that's quite a complicated document with lots of recommendations in it. I haven't had a chance to review it thoroughly, so I don't want to comment on too many details, but I would say it underscores the importance of capital, liquidity, stress testing, and resolution planning in having a safe and sound banking system, which are views that I and my colleagues have long espoused. Regulatory burden, when it's possible to ease it, and a good deal of the Treasury report is focused on regulatory burden. That's something that all regulators should be looking to do. We strongly believe in the importance of tailoring our regulation to the size and complexity of institutions, of finding ways to relieve burden for community banks. We have been focused and had a number of initiatives already in that direction, looking for ways, for example, to simplify capital requirements for community banks, and will continue in that direction, and in that sense, in those areas, certainly share the views expressed in the Treasury report. So there are a number of areas and suggestions where our thinking aligns well. There is probably some areas where we're likely to have differences, but quite a number of areas where we're likely to be able to, and already are taking actions that are consistent with those recommendations. Well, I have felt that it's been appropriate for interest rates to remain low for a very long time. We are in the process of, as the economy strengthens, normalizing interest rates, but certainly we've had a lot of years in which interest rates have been low. I thought it was necessary to support the economy at that time and was strongly in favor of those policies.
Thank you. Karen Maracek with Market News International. Today, you guys outlined the details of the plan to when you begin to end reinvestments, but you stopped short of saying exactly when it would be implemented, only saying this year, and adding that depended on how the economy evolved. Can you tell us why you decided not to go ahead with it today? Is there certain conditions that you're looking for? And then as a second question, do you think that you could raise rates and begin implementation of the plan at the same time? Thank you.
So we have tried as meticulously as we can to provide advance warning to markets about how we would go about doing this so that market participants can prepare. And today's announcement is another step in that process. So we certainly wanted to get this information out before we actually undertake the beginning of this plan. And, as the statement says, we've made no definite decision on the timing of the plan, but the timing of initiating the plan. But if the economy evolves in line with our expectations, which, we will be watching, always are, we could put this into effect relatively soon. You asked about whether or not we would do that and raise rates at the same meeting, and I would say we've made no decision about that, and it really hinges on the outlook and our assessment of conditions.
Hi, Victoria Guida with Politico. You mentioned the Treasury report, and I just wanted to ask, how much weight do you give those recommendations in considering potential regulatory changes moving forward? And also more specifically, one of the recommendations relates to the Volcker rule. I know you've said in the past that, it might be a good idea to reduce the burden on community banks, but it also talks about potentially exempting banks with trading assets and liabilities above a certain level. And I was wondering if you think that that's an idea that's worth exploring, that might be a good idea.
So we have previously suggested exempting community banks, smaller banks, entirely from the rule. And a number of my colleagues have spoken about the Volcker rule. Implementation of it is frankly complex, and I'm certainly open to looking at ways to reduce regulatory burden in that area. The report endorses a restriction on proprietary trading. So in that sense, it endorses the main objective of the Volcker rule, which I was pleased to see. But on implementation, it's true that the rules were in partly reflecting the way the legislation is written, were, I think, necessarily complex, but we do have some ideas for how we might simplify the rule, and certainly it's something we're quite open to looking at. Well, I mean, Treasury has set out a list of objectives for regulation that I'm sympathetic to and endorse. I think looking for ways to reduce regulatory burden when it can be done without sacrificing safety and soundness or creating systemic risk, that's something that all regulators should want to do. We've done an awful lot of rule writing over the last 5 or 6 years, and coming back and looking at where we've created burdens in ways in which we can simplify to reduce, that is an objective that is core to the Treasury review, and that we're very sympathetic with. So while we may not agree on every detail, certainly the suggestions that are made there are ones that we will pay attention to, and in many cases are already on our own list of things we should review.
Mike Derby from Dow Jones Newswires. In light of the plans to trim the balance sheet, hopefully later this year, what have you learned about QE and bond buying policies as a tool for monetary policy when they were launched, and what something you had engaged in that scale before? A lot of fears that it was going to create hyperinflation. That hasn't ever seemed to come to pass. So in light of QE as potentially a tool for the future, might come back again, what have you learned about how it works in the economy? Like, where do you see it affect things? What are sort of the lessons learned of the experience?
Well, thanks. That's a great question. I mean, staff in the Federal Reserve and outside economists have done a great deal of work trying to evaluate QE. I think the general conclusion is that it has worked in that it has put some downward pressure on longer term interest rates, so-called term premiums embedded in longer term interest rates. There's disagreement among economists about exactly how large those effects are, and it's something that's difficult to pin down, but obviously it has not caused runaway inflation, quite the contrary. I mean, that was never my expectation, but I do remember when people were afraid that that would happen. We do have the tools. We've, even with a large balance sheet, we intend to shrink our balance sheet now, but even with a large balance sheet, we retain the ability to move the Fed funds rate and set it as appropriate for the needs of the economy. So I think we have learned that it works. It's a valuable part of the toolkit. It's something that if we were to encounter an episode in the future of extreme weakness where I've said we want the Fed funds rate and movements in short-term interest rates, that's our go-to number one main policy tool. But if we were to hit the zero lower bound and constrained in our use of that tool, certainly balance sheet policies and forward guidance at the type that we provided, I believe, based on the evidence of how they worked, ought to remain part of our toolkit. And we have said in the bullets that we released today on our balance sheet that in such an episode of such extreme weakness in the future, those are things we would consider going forward.
Limit to how high you might want to push the balance sheet, or could you envision it going higher if you needed to?
Well, we've had no discussion of that issue, and our focus now is on getting it back to a more normal size. But I would say the use of QE in the United States relative to the size of our economy is not as high as it's been in some other countries that have employed it. But that's something we haven't seriously even discussed.
Chair Yellen, Patrick Gillespie with CNN. It's Workforce Development Week at the White House, and you highlighted several successful job training programs in your speech in March. The president's budget has a 40% cut to job training programs. What is your response to the budget cut to job training programs, even though they expect to expand apprenticeship programs? And do you believe that job training programs and apprenticeships are needed to help fix the job skills gap in the economy?
Well, I'm not going to comment on the president's budget, and these programs can be undertaken at many different levels. I've seen many nonprofits and states and local authorities put in place programs that look to me to be successful. I do think we have a tight labor market, and one where employers have jobs where they're finding difficulty identifying workers with the appropriate skills. In my own discussions with businesses, what I hear more of, and this is something I think is a great aspect of a tight labor market, larger firms are spending more on training and trying to, given that they can't hire workers with the ideal skills, are training people to fill jobs that they have available. What I hear from CEOs of smaller firms is that they don't have the ability to launch such programs. They would really very much like to participate along, for example, with community colleges or nonprofits to see such programs launched and have jobs that people could fill if they receive the appropriate training. So I do think that this is an important area, and especially given the pressures that have, existed for a long time, downward pressure on wages and job opportunities, especially for those with less skills. I think that this is something that deserves priority. Thanks.
Okay.
Yeah, she's done.
Woohoo!
Was long.
Yeah, it's usually 1 hour, and most of the news comes out at the beginning.
Yeah. Anyway, we can do a wrap up about this, right? I see the dollar is gaining some further traction, but still within range for the most against most of its rivals, and down against the Aussie and the yen, right?
Yeah, we have complete U-turns in the Aussie and euro dollar especially. Look at this U in pound dollar, and also dollar yen. Well, dollar yen is moving slowly to the upside.
Yeah.
Hasn't gained all the ground. All in all, Yellen's hawkishness helped the US dollar.
Yeah, indeed. I'm taking a look at yields. The advance is quite modest and are still down daily basis, so that will hold on a bit more. The Japanese yen process, maintain the bit. Taking a look at particularly now at gold. Sorry, that's breaking lower. So that's a hint of where the dollar may address over the upcoming hours. Remember, guys, that US closes in about 30 minutes, so we have low volumes until Tokyo opening. But anyway, to wrap up the press conference, I guess we have been surprised by a hawkish Yellen, right? Less worried about inflation, more confident about growth, not willing to discuss Trump, and still in the path of raising rates 3 times this year, the same for the next. Overall, it was a surprise. The effect was, however, offset by the early decline in the greenback amid poor inflation as the market rushed to price in a dovish Yellen, for exactly the contrary we thought. But still, the dollar is not seem to be poised to recover further, right? Not longer term, not sustainable gains for me. Okay, as I said earlier today, only below 110.80, 10.75, which was the low set in April here, sorry. Then I do see that some chances of a downward move in here, but not much more to add. And for the upcoming Asian session, beware of VOC, beware we have employment data in Australia, and that's usually a big market mover. Pay extra attention to full-time employment creation. And remember, we have a Bank of England tomorrow, Bank of England, and how it will affect the poor wage we read today, okay, in the employment report. So stay tuned to FXStreet for all of these matters, guys. Anyway, your wrap-up, Yohay.
Yeah, well, the Federal Reserve raised rates as they told us they would do. There were some doubts because inflation fell. Today we had data that was much worse than expected. They still raised rates. They still expect to raise the rates, interest rate once more this year, probably in December. The dot plot was fully unchanged. They did acknowledge lower inflation by saying they will monitor it closely, and they lowered the forecast for the core PCE. But Yellen, in her press conference, was quite optimistic about inflation. She had excuses, prescription drugs and telephone bills, one-off effects. She used the words one-off. That means it's she shrugged it off. The falling inflation is temporary, and it is expected to rise, according to Yellen. And in general, she was optimistic. The hike reflects progress in the economy. Exports reflect stronger global growth. And in general, she saw the glass half full. So that's why we're seeing the dollar return against some currencies to where it was before the poor inflation report, not against dollar yen. We're seeing the doubts in dollar yen, but in euro dollar, Aussie dollar, pound dollar, we're seeing basically as if the inflation figure didn't happen. I'm happy that we had volatility beginning earlier today with the inflation report and a full U-turn on the Fed. For the longer term, I think that Yellen is too optimistic and that reality will bite eventually. Inflation is just too low, and there's still a lot of slack in the US jobs market. So the longer term, I haven't been convinced, haven't turned into a dollar bull, but time will tell. We're data dependent.
None of us has become a dollar bull after this press conference. Anyway, thanks all for being here with us. Thanks particularly Yohay, all the FXStreet team in the background that make this possible. And hopefully we will see you back soon, okay? Thank you all, and bye-bye. See you. Bye-bye, Yohay.